Hey everyone, welcome back. Let me tell you a quick story. Two friends, Raj and Aman, each invested 1 lakh rupees back in 2016. Raj put his money into a fixed deposit. Aman started a SIP in mutual funds. Fast forward to today, in 2026, the difference in what they have now might genuinely surprise you. But before I reveal that, let's break down exactly where you should be putting your money. Mutual funds, stocks, or FDs, based on your financial goals. Let's dive in. Whenever people think about investing, 3 options usually come to mind first. Fixed deposits, safe and predictable. Stock market, high risk, high reward. Mutual funds, the middle ground. The problem is, most people jump in without truly understanding these options and end up regretting it later. Today, we're breaking down all 3, covering risk, returns, liquidity, and taxation, so you can make an informed decision. 1. Fixed deposits. A fixed deposit is simple. You park a lump sum with a bank for a fixed period, and the bank pays you a guaranteed interest rate. Advantages: guaranteed returns. Market conditions don't affect your interest rate. Extremely safe, especially with RBI-regulated banks. Beginner-friendly. 0 research required. Disadvantages: returns are low, typically 6 to 7% annually. After adjusting for inflation, real returns are even lower. Interest earned is taxable as per your income slab. Your money is locked in. Early withdrawal often comes with a penalty. Best suited for people who can't afford any risk or those who need the money in the short term. Think emergency funds. 2. Stock market. High risk, high reward. When you invest in stocks, you're buying a small ownership stake directly in a company. Advantages: highest return potential. Many stocks have delivered 20–30% or more annually. You're in full control. Which company, when to buy, when to sell. The most powerful way to build long-term wealth, historically. Disadvantages: highest risk. A market crash can significantly erode your capital. Requires research and time. You need to study company financials, sectors, and market news. Emotional discipline is tough. Many investors panic sell at the wrong time. Best suited for people who understand the market, can dedicate time to research, and are comfortable taking risk for long-term gains. 3. Mutual funds. The best of both worlds. A mutual fund pools your money together with thousands of other investors, and a professional fund manager invests it across stocks, bonds, or a mix of both. Advantages: professional management. Experts handle your investments for you. Diversification. Your money is spread across multiple companies, reducing risk. You can start small with a SIP, as low as 500 rupees a month. Good liquidity. Most funds allow easy withdrawal. Disadvantages: fund managers charge a fee, known as the expense ratio. Returns aren't guaranteed. They're linked to market performance. With so many fund options available, choosing the right one can feel overwhelming. Best suited for people who want solid returns without directly picking stocks themselves and without dedicating a lot of time to research. Bonus: comparison table. Let's visually compare the pros and cons of each option side by side. This table helps you see the key differences clearly. Factor: fixed deposit, mutual funds, stock market. Risk level: very low, medium, high. Average return: 6 to 7%, 10 to 14%, 12 to 20%, plus variable. Liquidity: low, lock-in period. Good, very good. Minimum investment: 1,000 to 5,000, 500 via SIP. Depends on stock price. Knowledge required: none, low, high. Tax on gains, as per income slab. LTCG/STCG rules. LTCG/STCG rules. Ideal for emergency fund, long-term wealth building, active investors. So where should you actually invest? Here's the truth. These 3 options aren't really competitors. They're the 3 pillars of a well-balanced investment portfolio. Here's a smart strategy to consider. Emergency fund, 3 to 6 months of expenses. Keep this in an FD or a liquid fund. Long-term wealth creation, retirement, buying a home, children's education. Build this through mutual fund SIPs. If you understand the market and can take on extra risk, allocate a portion to direct stock investing. The golden rule: base your decision on your risk appetite, your investment time horizon, and your liquidity needs, not just the returns you're chasing. So there you have it. A clear breakdown of fixed deposits, mutual funds, and the stock market, and how to figure out what's right for you. If you found this video helpful, hit that like button, subscribe to the channel, and let me know in the comments, where are you currently investing your money? Coming up next, how to start a SIP, a step-by-step guide. Turn on the notification bell so you don't miss it. See you in the next video. Invest wisely and take care of your money. Disclaimer: this video is for educational purposes only. Please consult a certified financial advisor before making any investment decisions.